So we've been able to look at a few formulas here. I don't know whether there is anybody who will be able to remember the formula of getting maximum exchange ratio. Is there anybody who can remember the formula of the easier one? The easier formula of getting maximum exchange ratio? Maximum exchange ratio formula. Yeah, I'll be able to address those questions. I can see them. So maximum exchange ratio formula, like now we are doing mergers and acquisitions. We had already begun. The easier formula, the very easy formula that all of us should be able to know, mergers and acquisitions. Yes, so we have EPS of the target company, EPS of the target company, all over EPS of the predator company. Remember, predator company is the one that is buying the smaller one. All right, so we've got two companies, A buying B. If A buys B, then A will be called the predator, A will be called the predator, and the B will be called who? The targeted company, like that. B will be called the targeted company. So anytime they want you to get maximum exchange ratio, you'll always take the EPS of the targeted company, EPS of the targeted company, all over EPS of the predator. So you take EPS of B all over EPS of A. Remember, EPS stands for what here? Earnings per share. When we talk about maximum exchange ratio, you're supposed to appreciate that this gives us the number of shares that we shall be able to exchange. What is the maximum number of shares shall, for example, the parent give out in acquiring a targeted company in such a way that the EPS of the predator company does not reduce. EPS of the predator company does not reduce. So here, would want to protect the EPS, would want to protect the EPS of the predator company whenever you are calculating the maximum exchange ratio. How about this one lastly, as I go to today's agenda? What if you want to get what we call the post-acquisition EPS pretty fast? Is there somebody who is able to remember the formula of getting post-acquisition EPS? Post-acquisition EPS will be equal to who? Post-acquisition EPS will be equal to who? Is there anybody who is able to remember? After we acquire now this targeted company, after we acquire the targeted company, post-acquisition, not the normal acquisition, not the normal EPS, post-acquisition. Yeah, I can see NJ there. Post-acquisition, yes. Post-acquisition, yes. So post-acquisition, the two companies now will become one. So we'll talk of earnings of company one plus earnings of company two, post-acquisition. Now the second company has been acquired. The second company has been acquired. Once we have the second company acquired, then the group's earnings will be earnings of company one plus earnings of company two. All over ordinary shares of the two companies. Number of ordinary shares of company one plus number of ordinary shares of company two times what we call exchange ratio, times what we call the famous exchange ratio. The famous exchange ratio times what we call the famous what here? The famous exchange ratio. The famous exchange ratio. So we want to begin from here today. As a quick way of a recap, I would want us to look at most recent past paper questions. Like there is one that came here which really terrorized students. I don't know why, and to me it's quite an easy question. So I would want us to start with December 2023, question 3B. December 2023, question number 3, boy. Once you get this question, can you kindly put your thumbs up like this? And then if possible, please share this with your colleagues on WhatsApp. Share this with your colleagues on WhatsApp. Share this with your colleagues on WhatsApp. Once you get it, Put your thumbs up like this. December 2023, question number 3B. For those of you, of course, who have got these books, we're looking at, which page is this? We're looking at page number 100. Page number 100. Kubwa Limited. Kubwa Limited. The question itself is known as Kubwa Limited. Kubwa Limited. Kubwa Limited. The question itself is known as Kubwa. Kubwa Limited. Kubwa Limited. Kubwa Limited. Kubwa Limited. Once you guys get it, I can see Kerry Odanga saying thumbs up like this. All right. So, ladies and gentlemen, this is what we have. Kubwa Limited, we are told there, is considering acquisition of Ndogo Limited. So Kubwa will acquire Ndogo. So Kubwa becomes the predator, Ndogo becomes the targeted company. The targeted company. A firm in an unrelated line of business, in order to diversify their risks, selected financial data for both firms are provided as follows. Additional information: Kubwa Limited is considering financing the acquisition of Ndogo Limited using a share-for-share exchange or a share debenture exchange. 2, corporation tax rate applicable is 30%. So we are doing this December 2023. December 2023. Question number 3B. Somebody has already shared the question on the group, WhatsApp group. So they want us to give them the non-diluting maximum exchange ratio. Non-diluting maximum exchange ratio. So I would want to give you exactly 2 minutes for you to think through. Or somebody has not yet shared the question. I want to give you exactly 2 minutes for you to think through, in this case here, this question, which is quite an easy one. I can even give you a formula. Remember, once they call it maxi, non-diluting exchange ratio, this is the same as maximum. Maximum exchange ratio. Maximum exchange ratio, what we shall be abbreviating as MER. MER. I'll go ahead and give you the formula. But I'm so sure even with the formula, very few of us will be able to know how to apply it in this case here. It is EPS of the target company, EPS of the target company, all over EPS of the predator, all over EPS of the predator, EPS of the target company, all over EPS of the predator. Anytime they want us to give the maximum exchange ratio, we shall always take the EPS of the targeted company all over EPS of the predator company. But you see, this was quite a tough examiner. What this examiner did, this examiner, you know, the examiner was really used to giving us the EPSs. It was basically chewing everything up for us. Ours was always to swallow, because he used to give us EPS of the targeted EPS. Now here he never gave us that information. Here he wanted us to derive that information ourselves. But I mean, who are we not to do this? This is a very easy question. I'll be able to derive this pretty fast. Pretty fast. How do I do this? Look at the table given there. The table given there, they have given me sales. They have given me cost of sales. They have given me operating costs. And then they have given me finance cost there. Given that information, I will be able to get profit after tax. Remember, for me to get EPS, I must get what we call the distributable profit. And this distributable profit is basically profit after tax. So then this is what I will do. I don't have to go through the long way, but just to show you, for the two companies, we have Kubwa, and then we have Ndogo. So we have Kubwa versus Ndogo. So in this case here, they have given us sales. They have given us sales. Sales here is 100, and here we have 50. So it shall come and less cost of sales, less cost of sales of 30. Then we have 10. Of course, I can take a shortcut of just deducting everything without going through this gross profit. But for your case and the sake, so gross profit, here it will be 70, here it will be 40. So once you give me this gross profit, then I should be able to subtract the operating expenses, administration, distribution. Here we were lucky because the examiner combined both. He combined all those and called them operating expenses. So in this case here, we less the operating expenses like that. So operating expenses, what do we have here? Operating expenses, we have 10 and 5. 10 and 5. So subtract like that. Once you subtract like this, then we'll be able to give us what we call profit before interest and tax. You'll be able to give us profit before interest and taxation. Because now you see operating profit, you have been able to wipe away all the other expenses except what here, interest or finance cost and taxation. So then this gives me 60 here. Here I have 35 like that. So once I get this en route to getting PAT, I know the next thing I will do is to come and less interest. So we less interest. Remember, interest is the same as finance cost. Interest is the same as finance cost. So are we able to see the interest here? Are we able to see the interest here? The finance cost is 5 versus what here? Versus 2 like that. So 5 versus 2. So if I do it like that, now this is without interest. I've been able to subtract interest. So this will be profit before tax. This will be profit before tax. So profit before tax, what do we have here, my friends? It is 55. It is 33. 55 versus 33. That's profit before tax. So then go ahead and give us, ladies and gentlemen, go ahead and give us corporation tax. So we less tax. So we less tax. Has this examiner given us the rate of tax? Yes. He has given us 30%. He has given us 30%. So please give me 30% of 55. 16.5 and 9.9. 16.5, 9.9. 16.5, and then we have 9.9. All right. So please come here and deduct. Come here and deduct for you to be able to give us what we call the PAT, profit after tax. So go ahead and deduct. So I have here 38.5. The first one, I'm being given a figure of 38.5. 38.5. And then we have here 23.1. 23.1. 23.1. Let me pause there a little bit and ask you guys, if you got this kind of a question in an exam, do you think you would have driven this question up to where we have reached in an exam situation? In an exam situation, I can see Edda saying yes. Great. Thank you so much. So we are lucky. Here we don't have anything to do with what here? We don't have anything, ladies and gentlemen, to do with the preference shares. So it means automatically that whatever we have here is distributable to ordinary shareholders. Whatever we have here is distributable to ordinary shareholders. So go ahead and give us the no's. No stands for what we call number of ordinary shares. So number of ordinary shares, what do we have here? That has been given to us faithfully. But if I were the examiner, I can't give these students number of ordinary shares directly. No. These students, in this case here, you need to twist them a little bit. Just give them share capital for each company, and then give them par value. Give them share capital for each company, and then you give them par value. So if you're given share capital of companies and the par value, how will you be able to extract number of shares from those two metrics? You're given share capital in shillings, and then you have par value somewhere. Par value could also be captured in form of brackets. How will you be able to get number of ordinary shares? You take share capital, you divide by par value. Share capital, you divide by par value. Yeah, the quotient, yes. You divide, yes. You divide, yes. But here, this examiner was lenient. Perhaps he had not done his homework well. He gave us here a number of issued shares. So we have here 10 vis-a-vis 7. 10 vis-a-vis 7. And then now with this, we can easily go ahead and provide our examiner with EPSs. So EPS, remember, is what we call profit attributable to ordinary shareholders, PAOs. PAOs. Profit attributable to ordinary shareholders. Here, there is nothing like to be weighted here. So divided by NOS. So please write this in full. This is profit attributable to ordinary shareholders. Profit attributable to ordinary shareholders, PAOs. profit attributable to ordinary shareholders, all over number of shares, number of ordinary shares, number of ordinary shares. So then I can very comfortably come and give them EPS. EPS of Kubwa. EPS of Kubwa, all these profits here are attributable to ordinary shareholders because we don't have any preferential shareholders. So then here we have 38.5. 38.5. We divide this by the number of shares outstanding, which are 10. So EPS of Kubwa will be 3.8 what? 3.85. Is that okay? 3.85. And then we have EPS of Ndogo. EPS of Ndogo. EPS of Ndogo. So EPS of Ndogo, it will be 23.1 divided by 7. 23.1 divided, which gives me, according to Ida, 3.3. 3.3. 3.3, like that. According to Ruth as well, thank you so much, 3.3. Now, any student who was able to derive these numbers, then was able to get maximum exchange ratio without breaking any sweat. Because to get maximum exchange ratio, we take EPS of the targeted company, EPS of the targeted company, all over EPS of the predator. And in this particular case, which company is the targeted company? Which company is the targeted company? In this case, which company is your targeted company? Ndogo, yes. It's Ndogo. Ndogo is the one that is being bought. Ndogo is the one that is being bought. Actually, next time, if I were to be an examiner, I would simply come and say that Ndogo has acquired Kubwa. If I say Ndogo has acquired Kubwa, I'm so sure that I will be able to throw so many students out of this bus, under the bus actually. Because so many guys assume that Ndogo must always be the target of the company. This is not the animal kingdom where the Kubwa will always be chasing after the Ndogo. No, you must be told. Like in this question, ladies and gentlemen, we were told up there from the beginning, Kubwa Limited is considering acquiring Ndogo Limited. So Kubwa becomes what here? The predator, the swallower, the buyer. So then EPS of the targeted company, are you able to see EPS of the targeted company? This is Ndogo. And you happen to be having, ladies and gentlemen, EPS of Ndogo, which is 3.3, all over EPS of the predator, which is Kubwa, which is 3.85. 3.85. So I want this answer in the form of a fraction. Sherry has given this to me. So in the form of a fraction, this gives us 6 over what here? 6 over 7. In the form of a fraction, 6 over 7. 6 over 7. How do you do it? Normal division in the calculator. 3.3 divided by 3.85. After you say equals, you look for a button there in your calculator written AB over C. There is a button there written AB over C. So this AB over C is your, button to change decimals to fractions. Once you press it, it gives you the fraction. Is there somebody who has tried that? Is there somebody who has tried that AB over C thing? It's just on top there. It is just on top there, ABC. How I wish I had a very great student, a student who knows that we are in this world to serve humanity, who can even take a screenshot of their calculator and then they circle that ABC. You can circle it in red. You circle it in, and then you share with comrades here. You share with comrades here. You just do the normal division. Normal division is 3.3 divided by 3.85 divided by 3.85. Whatever you get there, you now press this ABC thing. You press ABC thing. There are some calculators, ladies and gentlemen, when you just press this divided by this, it gives you a fraction directly. That is the thing. Exchange ratio shall always be given as a fraction. Always. It shall be given as a fraction. It shall be given as a fraction. It shall be given as a fraction. Any question, ladies and gentlemen? Anybody who has a question regarding what we've been able to do so far? Roman 2. The I love this post-acquisition earnings. Perhaps it's because I love marriage. Let's see post-acquisition, post-marriage. So post-marriage, if it's a working marriage, we expect, of course, in this case here, the earnings of these two people to be locked up in the same joint account. And once we lock it in the same joint account, it is the husband who should have, access to the entire amount. Alafu anakupanga we mama. Anakupanga wewe mama. So anytime we talk about EPS, post-acquisition EPS, post-acquisition EPS, so post-acquisition EPS. So post-acquisition EPS, post-acquisition EPS, every time we talk, this number 2 now, post-acquisition EPS, it will be earnings of company 1 plus earnings of company 2. Earnings of company 1 plus earnings of company 2 divided by their respective noses. So nose 1 plus nose 2 times what we call exchange ratio. Please write this in full somewhere there. This is what here, nose 1, this is number of ordinary shares. Number of ordinary shares. Number of ordinary shares. Number of ordinary shares. I hope up to there, these ninjas, I hope up to there, these ninjas are able to follow. And don't forget that this stands for total earnings, not EPS. I've always seen, and this is something I normally see, over 30% of the candidates who write this paper, they will always write this. They'll always take this as EPS, and then they get to 0, they fail. And then they keep on blaming Kasneb, blaming everybody else except themselves. So this is total earnings. It's what we call the PAOS, profit attributable to ordinary shareholders. To ordinary shareholders. Now, read this very well. They're telling us the post-acquisition EPS, assuming that there is an offer price of 30. Assuming that there is an offer price of 30. We learned, colleagues, we learned something here about situations when offer price is given. What do we say about whenever offer price is given? There must be some abracadabra that we must do here. Whenever offer price is given, what do we normally do? Whenever offer price is given, I'm telling you this subject, and I can tell you for free. You just watch around the students who keep on giving answers. You may think that I know Kimbelembele, but just, I mean, I've taught this through Zoom for so long. The students who take a front seat virtually in a virtual class, they're always giving us answers. They're always asking questions. Those students will never fail. Never, never. They never fail. They never fail. Great. They never fail. DOP over MPS over, no, no, no. Remember here, we have 2 types of exchange ratios. Remember, we have 2 types. We have 2 types of exchange ratios. Exchange ratios, 2 types. 2 types. 2 types. Number 1, we have what we call the normal ER, normal exchange ratio. Normal exchange ratio, this one here, we use it when an offer price is given. We use it when an offer price is given. 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 So whenever an offer price has been provided, we shall never think about this other non-diluting exchange ratio. No, no, no. Whenever you are given an offer price, we shall always think about this normal exchange ratio. And how do we get this normal? How do we get this normal exchange ratio? We take the offered price. The offered price. We divide this by the MPS of the predator. Of the predator. Not MPS of the targeted company, not MPS of any other company, but we divide this by the MPS of the king. MPS of the king. So in this particular question, an offer price has been given. And whenever an offer price is given, we shall always, ladies and gentlemen, in this case here, we shall always use this normal exchange ratio. So the offered price is 30. From that same schedule, is there anybody who is able to see? Is there anybody who is able to see the MPS of the predator? MPS of Kubwa. MPS stands for market price per share. Market price per share, this is 40. Thank you so much, which will end up giving me 3 over 4. 3 over 4. So we have 2 types of exchange ratios. We have the normal exchange ratio. we have the normal exchange ratio. And then number two, we have in this case here what we call the non-diluting exchange ratio. Non-diluting exchange ratio. This is the same as the maximum exchange ratio. And this is the one that we get by using the EPSs. So we have here EPS of the target, if you recall, EPS of the target all over EPS of the predator, EPS of the predator. So we have got two types of exchange ratios. Anytime we want to calculate this, we must ask ourselves, which exchange ratio are we going to use? I'm so much aware of a student who will take the maximum exchange ratio we got up there and they keep on using that maximum exchange ratio throughout, and then they get a zero. Whenever you see an offer price being dangled on your way, you shall always calculate this normal exchange ratio that you have gotten here. Now, assuming, first of all, before I continue, up to here, are we comfortable, all of us, ladies and gentlemen? Up to here, are we comfortable, all of us? Are we comfortable? All right. Thank you so much. All right. Thank you so much. Thank you so much. Thank you so much. Thank you so much. So in this particular question, the offer price was given. Therefore, we had to calculate, in this case here, this normal exchange ratio, which is 3/4. Now, please listen. Please listen. Please listen. Come along with me. Let's walk this journey. Let's walk this journey together here. So we're looking at post-acquisition EPS. So I would want, in this case here, someone to give me the earnings of Kubwa. Because company one is always the Kubwa, is always the predator. So please look for the earnings of Kubwa without fearing anything. Just give me answers. Yeah, it is the PAT. It is the PAT of Kubwa, which we have been able to compute, which has given us 38.5. How about in this case here, the PAT of Ndogo? PAT of Ndogo from that schedule, PAT of Ndogo from that schedule, it is 23.1. 23.1. All over number of ordinary shares. There is a place there where they have given us number of ordinary shares outstanding or number of ordinary shares issued. So number of ordinary shares issued for Kubwa, somebody is telling me that it is 10. Somebody is telling me it is 10. It is 10. Plus number of ordinary shares issued. Sorry, this is supposed to be NOS. Please feel free always to ask questions. NOS 2. So this is the number of ordinary shares of the second company. Second company, which is 7, times this exchange ratio, which is 3/4. So, ladies and gentlemen, as usual, this is a journey we are working together. I'm so sure here body must normally put students down. So go ahead and combine, consolidate these two. Take this plus this. Give me an answer. First of all, we handle the numerator. So according to Javan, it is 61.6. 61.6 divided by, not many students will be able to get this right because I'm aware of some ninjas who will come and say 10 plus 7. They get 17. Then 17 times 3/4, which is very wrong. Body mass. First of all, multiply. And then you add. First of all, multiply, and then you add. Or in your calculator, you say 10 plus 7 times 3/4 without saying equals in between. You say equals at the end of the day. So I'm being told it's supposed to be 15.25. 15.25. Thank you very much. So then can you kindly go ahead and give us the post-acquisition EPS? Post-acquisition EPS according to NJ. According to Gina. Great. According to Dan Wangui. 4.04. Thank you very much. Thank you very much. That is post-acquisition EPS. And then now if you allow Mwalimu, I'll be able to go to Roman 3. And the good thing with these mergers questions, you can always guess. And even, know the pattern of what will be asked next. So like now Roman 3, you can see there, the post-acquisition EPS, assuming 1,000 ordinary shares are exchanged for 10 units of 15% debenture with a par value of 100. So, ladies and gentlemen, here there is a debenture involved. And I gave you some secret. I told you whenever a debenture is involved, whenever a preference share is involved, there is something that I must always remember. Exchange ratio will always be equal to 0. Exchange ratio will always be equal to 0. Whenever you hear that there is a debenture in the acquisition, whenever there is a debenture in the acquisition, or whenever there is a preference share capital in the acquisition, then straight away at the back of my mind, I know that exchange ratio will be zero. 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 Will be zero. But you see, the very first thing after you have now known that the exchange ratio here will be zero, I'll have to think about the total loan issued. Not many students can give me the total loan issued. So for Roman, ladies and gentlemen, acquisition is through a debenture stock, a loan being issued to the target company, and therefore exchange ratio, you cram it that way, exchange ratio will be equal to zero. That's number one. Tick. Second tick. Come and tell us, ladies and gentlemen, come and tell us how much will be the total loan that will be given to these ninjas. Total loan to be given. So that one I'm giving you 3 minutes, you give me the answer. How much from the illustration given? They have told us the post-acquisition EPS, assuming 1,000 ordinary shares are exchanged for 10 units of 15% debenture with par value of shillings 100. I just want you to tell me the total loan that will be given to these guys. Please try. Ninjas, good ninjas are always fighters. Good ninjas are always fighters. Write down something. What do you think? What would have you written in an exam? So according to Linda Gasheri, 70. Nancy is confirming that 70. Where are men in the house? I would want to hear this man in the house. I would want to hear this man in the house. I would want to hear this man in the house. And J70. Imagine you'll get it 100%. If you just try to put down your pen on paper, you'll get it. You'll get that 70, yes. You'll get that 70, yes. I'm 100% sure. 70, yes. That's the correct answer. You know, it's very easy. First of all, you see 10 units, debenture 10 units, each worth 100. So 10 units, debenture, 10 units. So debentures, 10 units, and each is worth shillings 100, which basically gives us debenture of which equals what here? Shillings 1,000. So then how do we interpret this? This one here, they're telling us the post-acquisition EPS, assuming 1,000 ordinary shares are exchanged for 10 units of those. So it means that for every 100 shares they give us, for every 1,000 shares they give us, we give them a loan, a shillings 1,000 loan. We give them a shillings 1,000 loan. Then we ask ourselves, these guys were doing a complete acquisition. How many shares are they going to give us in total? In this case here, the number of shares they shall give us in total, the number of shares they shall give us in total, the number of shares they shall give us in total are the number of shares of the targeted company which are given there in full. If you look at the number of the nose of the targeted company, nose of targeted company. So the nose of targeted company there is 7. Is 7. Is 7. Is 7. So, ladies and gentlemen, in this case here, let's read this very well. Let's read this very well. Let's read this very well. I don't know why they were getting 70. Remember, it's 10 units, and each there has a par value of 100. Has a par value of 100. So remember now here, 1,000 shares, we give them a loan of shillings 1,000. How about in this case here, 7? You know, they have 7 shares. Forget about the millions. Never return the millions back. Never return the millions back. Never return the millions back. We are aware that there are millions, but because everything has been captured by, you just read this as 7. So in this case here for 7 shares, then what amount of loan are we going to give these guys? If every 1,000 shares, we're giving them shillings 1,000. What about in this case here, 7 shares? So go ahead and cross multiply. So if you cross multiply, then our loan to be given will be this 7 times this 1,000 divided by 1,000, which will end up giving me a loan of just 7 bob like that. Leave it like that. Leave it like that. That's the total loan. And then, ladies and gentlemen, we shall go and levy interest. We shall levy interest. Interest, they have given us a coupon rate of 15%. So 15% of the total loan. 15% of the total loan. Is there somebody who is able to give me this figure? What is 15% of the total loan? 15% of this total loan. Thank you, Wambuk. Thank you, Mike. Thank you, NJ. Mrs. Suzanne, great. Ada, great. So we are given here 1.05. Now, ladies and gentlemen, once I hit here, trust you me, that's very good. The next interesting area to me will be the formula. The next interesting area for me will be the formula. So I know this is about post-acquisition, EPS. But this time around, we are using a debenture acquisition. We are using a debenture acquisition. We are using a debenture acquisition. This will be equal to earnings of company 1 plus earnings of company 2 minus interest, because interest will eat into our earnings. Interest will eat into our earnings. So minus interest. So remember, this is after tax, this is after tax. So even the interest will be after tax. Why? Because interest is tax allowable. If it was preference dividend here, we don't subject it to this tax band. But interest is tax allowable. So the whole of it, you get interest after taxation. Everything to be divided by nose 1. Everything to be divided by nose 1. Why are we not bringing nose 2 here? Why are we not bringing nose 2 here? Because exchange ratio is 0. You know, at the end of the day here, the denominator, we should have spoken about nose 1 plus nose 2 times exchange ratio. Nose 1 plus nose 2 times exchange ratio. And the exchange ratio here, whenever debenture acquisition, preference share acquisition, exchange ratio is always 0. And you see 0 times this will kill this entire term. So always, whenever we have debenture acquisition, in the denominator, we shall have nose 1. We shall have nose 1. So please go ahead and plug in the numbers now. Plug in the numbers. Let's 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 plug in the numbers now. Let's plug in the numbers. Let's plug in the numbers. So is there somebody who is able to remember the earnings of company 1? Remember, that is profit after tax. I think it was 38.5. Yes. So this was 38.5 plus earnings of company 2. Earnings of company 2, 23.1, 23.1 minus the interest. Interest, we have got an interest here. Interest, was it 1.5 or something? 1.05, yes. 1.05 multiplied by 0.7, multiplied by 0.7, multiplied by 0.7. I'm so sure they have not seen where I got 0.7 from, because of the 1 minus tax, this one here, and tax has been given there as 30%. Yeah, tax has been given as 30%. 30%. All over knows 1. Number of ordinary shares, you guys have given me a figure of 10. Number of ordinary shares, you guys have given me a figure of 10. A figure of 10. So then I'm being told here that the final answer will be 6.08. 6.08. The final answer will be 6.08, which now takes me, I hope everybody is able to get that answer. How I wish everybody was picking their calculators to compute this. You know, there are students who assume that they will that they'll be able to get this answer by themselves, and then they copy down. So I'm being reminded here that Mwalimu is 6.09. Thank you, Oscar, for coming up with your figure independently, and you're telling me, Mwalimu, no, it can't be 6.09, it is 6.15. Oscar, let's first of all do the numerator slowly. Numerator slowly. 38.5, Oscar, plus 23.1 minus 1.05 times 0.7, and then you say equals. Weka answer yake kando. O Ruth pia amepata hiyo answer ya nani? Ruth amepata pia hiyo answer ya Oscar. Lakini kwa sure makosa inakuwa hawa wanafunzi hawaandiki kando hii numerator kando. Always andika numerator kando. Always. I shall write the numerators by the side because of body mass. So I'm waiting for you, Bwana Oscar, to confirm. Aha. It's not rounding off, uongo. It's not rounding off. It's not rounding off. Ili problem ya body mass inasumbuanga sana. 6.08 something, 6.09 is okay. Ya ukiround off inakuwa 6.09, yes. Ukiround off inakuwa 6.09. Oscar, I'm not now hearing you. I don't know whether we are together. So ladies and gentlemen, in an exam situation, how many marks would have you gotten there? Oscar is still getting 6.15. Numerator is 61.4. I think I should get my calculator now. I don't have it here, but I have. Or someone wants our help on WhatsApp. Who is this? Yeah, I think there must be somebody who removed our admin. Must have removed this guy because he was using these names of our competitors. And I normally tell them not to remove them. I don't fear. Now, unfortunately, once you are removed, you can't come back. That's why it's important that we get to rename ourselves. Decimal places, 2 decimal places is still good enough. 2 decimal places is good enough. So we are told here 38.5 plus 23.1 minus 1.05 times 0.7 equals. Don't say equals. I'm getting 60.8 something. Oscar, what answers are you using? What answers are you using here? What figures are you using here? What figures are you using? Oh, interest is 0.15. Anasema kwamba interest is 0.15. Okay. You know, interest given there, thanks for bringing that up. The interest given there, Oscar, The interest given there, Oscar, is 15%. The interest given there is 15%. But 15% is a percentage of something. Interest. Remember, interest is 0.15 times the loan that we got. Who is able to remind me that loan? Who is able to remind me that loan? How much loan did we get up there? It was 7. Oscar, try that. You know, it can't be 0.15 that is the interest. No. It's just like how you go to a bank and then a bank tells you 10% interest. If you borrow $1 million, you pay 100,000. We are together now. 50% of 7. Thank you very much for being adamant. Thank you very much for being adamant. That kind of concept is very good because we'll end up getting everything correct. We'll end up getting everything correct. All right. Now, ladies and gentlemen, after that, let's get straight away to another question before I go to the next concept. Before I go to the next concept, I would want us to do August 2023, question number 4B. August 2023, question number 4B. August 2023, question number 4B. So August 2023, question number 4B. August 2023, question number 4B. August 2023, question number 4 boy. Question number 4 boy. This is a very special question regarding number of shares of the to be given out by the predator in order to acquire a targeted company. In order to acquire a targeted company. So this question basically will help us understand how many shares will the parent company or will the predator we forgot something very, very important. We need to advise on the best financing plan. Thank you very much, Sylvia. The very best financing plan is the one that maximizes the EPS. So you look at the two financing plans and you tell us which one has got a higher EPS. That is what you recommend. Sorry for that. Please let's go back a little bit. Roman 4? Roman 4 of this question wanted us to advise on the best financing plan. And I'm explaining and saying that the best financing plan, whether you acquire using ordinary shares, preference shares, debentures, you look at all those, and then you'll be able to tell us, between them, which one will lead to an increase in EPS. Is there somebody who is able to evaluate those two? You know, we only have two ways of acquiring. Either we give away our shares That's Roman 2. So Roman 2 was giving us an EPS of 4.04. Is that okay? And then Roman 3 was giving us an EPS of 6.09. 6.09. 6.09. So in this case here, we recommend the debentures financing plan. We recommend the debentures financing. Debentures, yes, we recommend the debentures financing plan because it has a higher EPS. It has a higher EPS. Roman 2, we are giving cash as an offer. That one will give you 4.04. But when you give debentures like a loan, interest is allowable. Then in this case here, the group will be better off. The group will be better off. So please go back there and slot. Some students have not been able to see even what I'm talking about. There is a question asking us there, the question that we have just finished. There is a question asking us about the better between the two, advice on the best financing plan. So it is 2, 3. 2 and 3, between 2 and 3, I would rather the debentures one because the debentures is giving me 6.09. Debentures is giving me an EPS of 6.09. Then let's come back here. Number of shares to be given out by this examiner has repeated this concept quite a lot. How many shares will the predator company issue out in order to acquire a targeted company? Very important. If I were you, I would highlight this with yellow color. Highlighter, yellow color, yellow color, yellow color. Great. Thank you so much. So now we are doing this August now. Now we are here. Start with the required. So using the following valuation basis and assume no synergy effects accrue from the takeover, determine the total number of shares the directors of ACO Limited will have to offer to the shareholders of Bero Limited. Number of shares to be given out by who? By the predator company. By the predator company. I love this. Let's read the question. The statement of financial position of two companies, ACO and Bero Limited, as at this date, are shown below. So we have ordinary share capital, preference share capital, share premium account, we have profit and loss account, we have 10% debentures, we have non-current assets, net current assets. ACO Limited is proposing to acquire Bero Limited by means of an issue of its own ordinary shares in exchange for the ordinary shares of Bero Limited. The management of the two companies have availed the following information to assist in the takeover. So maintainable annual profits after tax, we have current market price per ordinary share, we have current earnings per share given there very, very well. So required, using the following valuation basis and assuming no synergy effects accrue from the takeover, determine the total number of shares the directors of ACO Limited will have to offer to the shareholders of Bero Limited. I will not start with Roman 1. I'll do Roman 1 as the very last. I would want to start with Roman 2. Number of shares to be given out. Number of shares to be given out. The very first thing, ladies and gentlemen, that I will start with is to write down the formula. So I'm doing Roman 2. Roman 2 is up on EPS basis. EPS basis here. So now how do I get those to be issued? Number of shares to be issued by predator. To be issued by predator. By predator. This is very easy. Very easy. We'll take the exchange ratio times news of target company. Times news of target company. Anytime they want us to give them news of the predator, NO stands for number of shares to be issued out by the predator. Always take the exchange ratio times number of ordinary shares of the targeted company. 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 And Roman 2, they want us to use EPS to calculate our exchange ratio. EPS, very easy. So in short, the nose of the predator will be equal to the EPS of the target. EPS of the target all over EPS of the predator. EPS of the predator times nose of the targeted company. Times nose of the targeted company. Right like that. And then try substituting yourselves. Try substituting yourselves. Give me an answer. Try substituting yourselves. You give me an answer. Try substituting yourselves to give me an answer. Try substituting yourselves, and then you give me an answer. You guys now have everything, really. Now you have everything. Imagine what it just takes is some confidence. Some confidence. Kuandike tu chini tu. Kuandika tu chini tu vile huyo jamaa ameandika huyo ni J. Huyo ni hivyo tu. Na kama una calculator wewe sema hata answer yako ni 0. And you'll be surprised because of bringing fun on the table, you'll be able to understand this thing. Try looking for those numbers. You know, there are many students are really failing this paper. I mean, I do to some extent. Of course, accountants are busy, but if you are a good student who knows that you would need to really be aggressive in class and try to repeat the questions that we do in class, repeat them, you will pass very easily. Very easily. You see, like I can even start with number of shares of the targeted company. I can even start with that. Number of shares of the targeted company. I can start with this. Number of shares of the targeted company. Number of shares of target company. I can see they have given me share capital. So I'll take share capital, divide this by the par value. Par value is the one given there in brackets, in the balance sheet, in brackets. All right. Thank you, Louis. Great. So share capital for the targeted company, which is a Bero. Bero is the one that is being acquired. I can see, ladies and gentlemen, that its share capital is 5,000. I'll not bother to return the thousands. So divide by 10. So this gives me 500. Is there anybody at least who was able to get this mark? Is there anybody who was able to get this, even if it's, great. Thank you so much. Now from there, come right away here and now get this. So we have here nose of predator. So nose of predator will be EPS of Bero. EPS is given in this table number 2. Table number 2. EPS, thank you very much, Oscar, for giving me quite a different answer. I love that so much. We're going to learn there, Oscar. Great. We're going to learn there, Oscar. Great. So are you able to see in this case here the current EPS ya Bero? Current EPS ya Bero ni ngapi? 3. Current EPS ya Bero, because I'm substituting here current EPS ya target. So 3 over EPS of the predator from table number 2. From table number 2, it is 2.4, 2.4, 2.4. I'll leave my figures in thousands. So in this case here, come and multiply this with what here? With that 500. So then this at the end of the day will give me what figure? 625, isn't it? So 625. Remember my figure somewhere if you remember. If you look at, for example, when you are dividing, I mean, lakini hata ukitaka tu vizuri, there is no examiner who will ever punish you because you left out these thousands. Remember when you were taking, it was supposed to be 5 million divided by 10, eh? So if I were you, I'll just leave it like this. Nobody can ever punish you. Nobody can ever punish you. Read the question again. Using the following valuation based on assuming no synergy effects accrue from the takeover, determine the total number of shares. That's enough. Nobody will ever punish you. So Oscar, are you able to see where you went wrong? Already I can see you have a figure. Now from there, we go to another basis then. So number 3, we go to another basis. Now this time around, they want you guys to use market value basis. Let me keep quiet for a minute. They want you to use market value basis. They want you to use market value basis. How are you getting 625? Yeah. Do you have these values? 3 over 2.4 times 500. Nancy, thank you for asking that question. I don't know whether you're able to see how we got these 3. Because if you have this 3 and you have this 2.4 times 500, you get this 625. Okay. So in this case here, you see this is EPS of the target company, and the barrow is the target company, barrow. And if you look at additional information, there is the second table there. You'll be able to see the current earnings per share. Yeah, barrow is 3. Yeah, barrow is 3. Now, Akon is 2.4. That's how we got in this case here, the exchange what year? The exchange 3 and 2.4. And then, of course, we had obtained this 500 by taking a number of shares of target company, taking the share capital. If you look at this first table given, the balance sheet given, the ordinary share capital of barrow is 5,000. We divide by the par value there, which is shillings 10. Shillings 10. I hope that is helpful. So market value basis. As Nancy is pondering on this, Nancy must have missed a couple of sessions in this. So market value basis, this is also known as MPS basis. MPS basis. MPS basis. So in this case here, ladies and gentlemen, to get number of shares of the predator. So now the exchange ratio will be on the basis of MPS. So very similar to this, but now you talk of MPS of the target, MPS of the target, all over MPS of predator. MPS of predator times, ladies and gentlemen, nose times nose of predator times nose of the predator, like that. Nose of the predator. Great, Nancy, at least you're appreciating there. And I'm so sure once you watch other videos later, you'll be at home. You'll be at home. So now we are looking for market price per share. Market price per share. Market price per share. Mr. Sutere, you really used to talk to me a lot. Please continue with what you used to do those days. This subject just needs somebody who wants to talk. If you talk, correct, you go to BDA. Haitaki mwanafunzi mpole. AFM. AFM inataka a lot of creative thinking. And these great juices of creative thinking, they can only be sparred if you're really getting into discussions. If you're not discussing, utakuwa unapata shida mingi sana, which will be very bad. Which will be very bad. Very bad. 1125. I'm being given a figure of, you see, MPS has been given, right? So 27 over 24. 27 over 24. 27 over 24. 27 over 24. And the stupid me, here we shall always use number of shares of the target company. Always. Because you see, we have number of shares of the predator. Sorry for that. So number of shares of the target company will remain as 500. Sorry for that. Will remain as 500. Will remain as 500. Will remain as 500, which gives us 112, which gives us 112 point what year? 112.5, like that. 112.5, which gives us 112.5. 112.5. Wamekataa hiyo 112.5. Wamesema mwalimu, hiyo ni answer ni ya uongo. Hiyo answer ni ya uongo. Wamekataa. Please, the students who are perhaps getting this 112.5, they're using the bad concept that I've given them here. Number of ordinary shares. It should be number of ordinary shares of the target. Number of ordinary shares of the target. It should be 562.5. 562.5. That is the correct answer. Now, there is one year when they brought this particular question in this sitting, very few students were able to get Roman 4. Very few students were able to get Roman 4. Very few students were able to get Roman 4. Very few students. Very few students were able to get Roman 4. Let me start by asking you a question. If, ladies and gentlemen, you are to get a situation where somebody promises you Kenya shillings 10 million every year, indefinitely. So you're given here a cash flow. You are given a cash flow of 20 per annum, and then N is indefinite, and R is 10%. Is there anybody who can give me the present value? Present value. Present value. Is there anybody who can give me the present value? Thank you very much, Javan. Javan amesema ikitu straight away mwalimu ni amount ama cash flow divided by R. Kwa hivyo inamaanisha this one will be 20 divided by 0.1 because 10% is 0.1. Yeah, amount of R, which will end up in this case here giving me 200 like that. Which will end up giving me 200 like that. So like in this particular question, we are going to use the same concept. Present value of future earnings basis. Future earning basis. Future earnings basis. So meaning that number of shares of the predator will be equal to EPS of the target, not EPS, sorry, will be equal to present value of maintainable profits of target, because we must start with target up there, all over present value of maintainable profit of predator times nose T. Nose T is normally number of shares of the targeted company. Number of shares of the targeted company. So many students were not, of course, they were able to get the formula, because you see, they can ask you about anything. So long as you remember it is about that thing for the target over that thing for the predator. So many students were able to remember the formula. They were able to, but now they were not able to proceed from here. Now, has the examiner given me the maintainable profits? Is there somebody from note number 2 who is able to see the maintainable profits? Yes. So maintainable profits here for Bero, it is 1.5 million. Maintainable profit is 1.5 million for Bero. So divide by the cost of capital of that Bero company, all over present value of maintainable profits of the predator, which is 2.4 million, divide this by R, times, of course, our 500 number of ordinary shares of the targeted company. Now, and this concept is really very, very easy. Why am I doing this? Because, you know, this profit is constant. It's per annum and constant. So it's an annuity. It's an annuity. Maintainable annuity. What we're able to maintain into the future. It's an annuity. And because it doesn't have a number of years at on site here, so we are better off assuming that they are what here? They are indefinite. But now this is one group. Whenever we acquire a company, this company becomes part of us. So it means that the cost of capital shall be the same. The cost of capital shall be the same. So this R and this R will be cancelled. That R and that R will be cancelled there. And then at the end of the day, you'll end up getting what figure? Just like this. Please listen, please listen here. If you're given like 20 over 100, divided by 30 over 100. Trust you me, let me use a 40 over 100. Trust you me, this will be the same as saying 20 over 100 divided by 40 over 100, which will be the same as saying 20 over 100 times 100 over 40. So this and this. So if you can see at the end of the day, we're getting 20 over 40. If these denominators are the same, if they're the same, we always cancel them directly. So we shall cancel this R and this R. And once we do such cancellation, then we should be able to get to this number of ordinary shares, which in this case here, they are what here? 300 what here? 312 point. What I normally tell my students, should they give you anything that you're not able to even comprehend very well? Like, you know, maintainable, you take the maintainable profits given, divided by maintainable profits of the predator. without even dividing anything. Yeah. So that PV is what confused students. Because you see, at the end of the day, the cost of capital will be the same between the two companies, because now they're marrying and becoming what here? Becoming one. Yes, Hassan has a question. I don't know whether my mic will work, but let's hear the question. It's good to hear the question. Just a minute. Charts. So now I'm looking for Hassan, yes. Hassan, are you able to unmute yourself? Yes. Hassan, are you able to talk? I can only hear a kid at the background. Am I the only one who can't hear him very well? Hassan, are you able to type? Are you able to type?
Yeah.
I was hearing you. Uh-huh. I'll give you a minute, Hassan. Just try typing very fast. Perhaps it's something you want me to repeat. Oh, accidental. Okay, okay. But I think he has a question. He has a question, but we shall overcome. Please feel free, Hassan, to put in something there. All right. Then now, with your permission, I will be able to go back to this net asset value. So net asset value, why I left it, the examiner keeps on confusing this area quite a lot. He'll always give us answers which are, one semester this using this formula, another semester. Now, ladies and gentlemen, please listen and listen to me very well. When we talk of net asset value, NAV, net asset value, NAV, you are supposed to know that net assets of a company, net assets value equals total assets minus total liabilities. I'll show you two methods here. Total assets minus total liabilities. Net assets basically are the equities of the company. Total assets minus total liabilities. Like now here we have got two companies. We have ACO, and then we have in this case here Bero. ACO and Bero. So these guys have given us total assets. Total assets. These guys have given us total assets. Total assets, total assets, total assets. You can see ACO down there where we have non-current and net current. ACO is 17,300. 17,300. 17,300. And the Bero is 6,100. So we search for any liabilities that they could be having. Do they have any liabilities? Do they have any liabilities? Do they have any liabilities? Oh, yes, they do. Number one, they have in this case here what we call debentures. Debentures. So debentures for ACO, debentures, we can see 10% debentures, 1,500 and 500. So 1,500 and 500. Do they have any other liability, my friends, my colleagues? See, I call you colleagues. You know, foundation level, even intermediate level, those are kids. But now here you guys are same level with me. We should reason. After this, you become a teacher. We should be able to reason together. We should be able to reason together. We should be able to reason together. Do we have any other liability? Anytime you see preference share capital is always taken as what here? A liability. Yes, Javan. is always taken as a liability. Always. Because you see, preference share holders, whether you're making profits or not, you have to pay them their dividends. So it is basically a form of finance that has got a fixed rate of return. Any form of finance that has got a fixed rate of return is now being taken as a what here? As a debt. As a debt. So in this case here, come and deduct preference share capital. Preference share capital, you deduct. So preference share capital, what do we have here? For ACO is 2,000. This other guy doesn't have any. 2,000, nothing. So then we have here our net assets. We never had the current liabilities here. They were deducted when getting the total assets figure. So please give me the net assets. Are you able to give me net assets of ACO? Net assets of ACO. Anybody who is able to give me 13,800. So this is 13,800. And then this one here will be 5,600. So then the exchange ratio, if we are using net assets basis, we shall take that divided by this. So we have here number of ordinary shares of the predator using net asset basis. It shall be net assets of the target, net assets of the target, net assets of the target, all over net assets of the predator, all over net assets of the predator, net assets of the predator, times, in this case here, nos T, times nos T, times nos T. Because now you see, for Roman 1 here, they have told us to use net assets model. Roman 1, net assets basis, net assets value basis. So then, ladies and gentlemen, this is what I will come and do. We have net assets of the targeted company, 5,600, over net assets of the predator, which are 13,800, times our 500 down there. And then I'll be able to show you another method. Another method. $202.9. 202.9. So in the exam, I would recommend you use these two methods. In the exam, you must use these two methods because the examiner has always gone ahead to give us contradicting answers. And at times when you try to push him, he says no. But research has it that this is the formula for getting net. This is the correct formula for getting net assets value. Net assets of a company equals total assets minus total liability. The other one that he keeps on repeating. So two methods, of course, they know to give us the same answers. The other one that he keeps on repeating, using this in the solutions, is what we call, we have here, net current assets. Net current assets, value basis. Net current assets value. So it is this net current assets value, where we take total assets minus current liabilities. Total assets minus current liabilities. So if I were you, I'll do using the two methods and I'll have to write this way. Net current assets value. It will be total assets minus current liabilities. So here we are lucky because already current liabilities were deducted. Already, if you look at this place, they have given us non-current. You see, how do we get total current assets? What are the total assets? To get total assets, we normally take non-current assets plus current assets. Plus current assets. So then when we talk of net current assets value, very, very confusing. You'll take these non-current assets plus current assets minus current liabilities. But now you see, this is what they are calling net current assets. So basically, if you look at that statement of financial position, they have taken net current assets, non-current assets. We have here non-current assets for the two non-current assets for ACO and for Bero. They have given me non-current assets. They have given me, I don't even have to write this really. They have given me 12,200. So we have here 12,200. And then we have Bero. Bero is 3,500. The non-current assets. And then the net current assets, net current assets. They have given me net current assets. What do we have there? 5,100, 5,100. And that's how they got these figures of 17,300 versus what here? 17,300 versus 6,100 versus 6,100 like that. So these are our net current asset values. Net current asset value. So then if you're using this to get our number of shares of the predator, you will come and take here the NAV, call it NAV over the target, NAV of the target over NAV of the predator, NAV of the predator times, in this case here, nose T like that, times nose T. So I want you to go and watch this video again. Very, very important. So when I come to repeat this concept, it will now become more clearer, and then I'll be able to explain why you need to use both methods in an exam. So our net asset value using this, it will be 6,100 for the Bero here, which is the target, over 17,300 times nose of the targeted company, 500. So what are we able to get, ladies and gentlemen? What are we able to get, ladies and gentlemen? $176.3. I'm so sure this is quite tough, but no worries. You just watch the video, and then when I come back, we'll be able to understand this very well. Mahabub, okay, great. So 176.3. Your homework, right there, homework, and the homeworks this semester, they must be done. Everybody must do homework. They must post the homeworks in the WhatsApp group. And remember, secret of a homework, and this is something you should even tell your children, homework, you do homework the same day. The same day it's provided. You don't carry forward homework. Homework. So the homework that I'm giving you guys is December 2022, question number 5C. December 2022, question number 5C. That one will be done today. Yeah, you can't get the same answers because you can't get the same answers. Can I give you 2 questions for homework? Will they be able to manage 2? Let me try them first of all with the one that I've given them 2 questions. Those will be too much for them. Just one, and then we see how they argue out. Now, that takes us to a very important area called valuation of mergers and acquisitions. Valuation of mergers and acquisitions. Are you asking about the homework question? Somebody should be able to type that homework question because I'm already out of that place. So valuation December 2022, yeah. So I hope you'll be able to take it now. So valuation of mergers and acquisitions. 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 So you have in this case here a company that has approached you wanting to buy all your shares. How do you get to value your business? You can't just say that I'm going to sell this thing for 10 bob a share, for 20 bob a share. No, we need proper valuation. So how do we get to value our businesses? So valuation of mergers and acquisitions. Now, I gave you a video last time when I'm so sorry. Unfortunately, I missed last Friday. Much apologies. I gave you a video on this valuation of mergers and acquisitions. Is there any student who was able to finish watching the entire video? Is there any ninja that was able to finish watching the entire video? Any ninja that was able to finish watching the entire video? And Jay, yes. Cynthia, Paul Thuo, Kiriodanga, I presume the same night, Javan, CK. Thank you very much. Those are enough yeses. Do we have any ninja that has never watched even for 10 minutes? Do we have any ninja? Do we have any ninja? At least Samoki tried. You watched up to somewhere. Do we have any ninja that has never watched even 1 minute? Why, Weston? Why? Kwa nini mko busy sana kwa namna gani? Almost. Great. 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 We shall overcome. I can see Paul never cry, Paul. I started, but at least you started, you know. So we have very many methods of valuing these mergers and acquisitions. One of the methods is what we call the PE ratio method. PE ratio method. Now, this PE ratio method, if you can recall, is there anybody who is able to remember the PE ratio formula? PE ratio formula equals who? PE ratio formula equals who? Anybody who is able to remember the PE ratio? It's price over earnings. Thank you very much. It is price over earnings. Price over earnings. Specifically, ladies and gentlemen, what you're supposed to remember is that PE ratio equals MPS over EPS. PE ratio equals MPS over EPS. Please make MPS the subject of the formula. Make MPS the subject. Make MPS the subject. Make MPS the subject. So it will be MPS times PE ratio. MPS times PE ratio. No. If you make MPS, sorry here. If you make MPS the subject, it should be left alone. So MPS will be equal to EPS. Sorry for that. It will be equal to EPS times PE ratio. So this is so important to us. Please come and highlight this. Highlight this, highlight this, highlight this in yellow. We don't want just MPS. We want total, you know, MPS is market per just one share. We want market value of the whole farm. So whenever you want market value of the whole farm, you get total value by taking total earnings. Total earnings times PE ratio. Total earnings times PE ratio. So anytime they want us to give them total farm value, you will take total earnings times PE ratio. Total earnings times PE ratio. Total earnings times PE ratio. So you don't have to cram like, how are we derived this? No, I'm supposed to know when I go to this particular area, this particular table, where gentlemen, where ladies are discussing about how do we value an organization, and then they mention a method called PE ratio, then I will take the PE ratio given times the total earnings of that firm. This is the formula that I would want to sell to you tonight. So anytime in this case, ladies and gentlemen, they talk about PE ratio method, anytime they talk about PE ratio method, to get total firm value, you'd always take, in this case here, the PE ratio given. This is how I remember it. PE ratio given, it must be multiplied with, because here we have over. For it to be compatible, it must be multiplied with total earnings. 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 So then PE ratio, this will be given. The total earnings of the firm that will be looking at valuing, will be also be provided to you. So let's look at May 2016, question 4B. May 2016, question number 4B. May 2016, question number 4B. May 2016, question number 4B. Once you get the question, please put your thumbs up. Like this. Like this. So once you get the question, please put your thumbs up live, like this. May 2016, question number 4B. Sherry has gotten it. Are you able to share the same to the group? Because there must be a ninja who has not yet gotten, there must be, like now as we teach, like now as I'm teaching so seriously, I'm 100% aware that there is a ninja who is eating ugali. I'm 100% sure there must be a ninja who is eating ugali now as I teach. That ninja can't look for a past paper. So please help him. Help him. Help him. Help that ninja. Yeah, huge and tiny, yes. Huge and tiny. Help that ninja. For energy. That's why I want you to be helped, I want you to be helped. Let them give you a paper. Make things easy for you. All right. So we are told, ladies and gentlemen, UG Limited intends to take over. Kisaka is floating. Kisaka is floating. What do you mean? I mean, like, is it the case for so many of you that you guys are floating? Are you floating totally, all of you? Because this is quite worrying. Most of our students here really are first timers. Don't go by the advertisement that I did. Yeah, Lizzie is also floating. Lizzie is floating. At least I can see guys who are following here, like Abdi, Jerida. It's sinking. Dan at least is following. Floating because it's their first time, I doubt, because the way I'm teaching, LMS guys is a sure bet. AFM Listima, I doubt. Hii kitu hata niwapatie siri ya AFM. Unaona kama Oscar was doing intermediate last semester. And you can see Oscar is trying, is giving us answers here. At times he's wrong, right? Asa kama hii, hata kule kuna kitu hapa, total firm value is PE ratio times total earnings, right? So we are doing this question called May 2016. When we go to this question called May 2016, look at required number 1. The offer price for Tiny Limited, if Huge Limited were to value Tiny Limited on a forward price earnings multiple of 8 times. The offer price for Tiny Limited, if Huge Limited were to value Tiny Limited on a forward price earnings multiple of 8 times. So they've given us price earnings. And we have said here, that anytime they want us, ladies and gentlemen, in this case here, to give them total farm value, which is the same as the offer, the price being offered, the offer price for the farm, farm being sold. Take the PE ratio, which in this case here is 8 times in this case here, the total earnings of that farm. Let's read the question we see. We are told here, Huge Limited intends to take over Tiny Limited, another company in the same industry. Tiny Limited is expected to post earnings of what year? 86. This company want to acquire is intending to post earnings of 86 million next year. So they're basically giving us the total earnings. So total earnings of the farm that they want us to acquire is what year? Is 86. Is 86. So is there somebody in this case who is able to give us the moment you just appreciate the formula, the moment you appreciate the formula here, the total offer price for Tiny Limited, if Huge Limited were to value Tiny Limited on a forward means future earnings. So it is PE ratio times total earnings, like that. And you're done. Which gives us what here? Somebody 688, like that. So perhaps the students who have really floated here could be those students perhaps who aren't there in our last class. Our last class, we did something on mergers and acquisitions. We're able to complete a question, exchange ratio, etc. So today they have gotten a hard time. So what you need to do is to watch the first class's video plus what we have done today. Plus in this case here, this video on valuation of what year? Valuations of mergers and acquisitions. Valuation of mergers and acquisitions. Once you do that, then you will be sorted out. Utashika. But most importantly, tukisema kama hii kitu 8 times 86, hata kama uoni wewe chukua calculator punch, tupatie figure. Utapenda sana AFM. Lakini ukikaa uanze kufikiria kuna wanafunzi who are very advanced than you, hakuna. All of us, I can assure you, we are the same. The only difference I know, there are students tukisema tuende kwa mergers, au wanakimbia kwa hii LMS. Unaona kwa hii LMS mnasema ijapangwa vizuri. Wanakimbia kwa LMS, videos za last semester zote wana watch. So akija class kama UNJ, akija class hapa amejua sana. Like now after this topic, I'm going to a topic known as what here? Real estate finance. So real estate finance is quite a short topic. You should be able to watch all the videos the last semester kwa LMS and then you are done with it. Hata usiwatch zote, kwa kila topic wewe watch video mbili. Kwa kila topic video mbili, ukuwe na idea. Tukija kwa class hapa, mwalimu should be able to hammer as many questions a past paper as possible. Like today, apart from this, I was also intending to do another question. But of course, because of time and there are students who are saying, mwalimu, hatufuati, itakuwa ngumu sana kuwafinya sana, itakuwa disaster. But I would rather, if for example, you guys were just to go like now real estate finance, you get into real estate finance, videos of last semester, watch the videos which are the first 2 or 3 videos. So nikija hapa, mimi nikiongea mambo moja mbili joke, na hama questions 5 every class, kuisha maneno. That way you will be sorted out big time. Where is the 8 coming from? Rudia, yuko amesema rudia hapo. Great. You see, what are we told? Look at the question. Look at the question required. Look at the required. We are told here the offer price for Tiny Limited. If Huge Limited were to value Tiny Limited on a forward PE multiple of 8 times. So the PE ratio has been given us 8 times. The PE ratio. This has been given us 8 times. So then what I would want to get is the total earnings of this farm that you're going to value. Total earnings of the farm that you're going to value. All right. And where have they given us this? Read paragraph number 1. Huge Limited intends to take over Tiny Limited, another company in the same industry. Tiny Limited is expected to post earnings. You can see the earnings there are what year? 86. Earnings are 86. So in this case here, PE is 8 and the earnings of the company is 86. So those two parameters should be able to give you the value of the firm. I hope that is clear. I hope that is clear. Then the other thing, ladies and gentlemen, as I run away, it will be important. Usingoje tufanye class paka mwisho useme una float. I'm a very friendly person and a very patient person. Ukiinua mkono useme unataka kuuliza swali tukianza from beginning, I'll always repeat. Always. Always. Ukingoja mpaka mwisho useme una float, hautasaidika. Kama kuna wanafunzi ambao sikuwa mnawajua, kuna wanafunzi ambao walikuwa kierere, hiyo jina sio mzuri sana. Kierere sana. Yani walikuwa wanaongea sana kwa group. Huyo mwanafunzi angekubali uende mbele kama hajajua. Those are the kind of students we want. Unasema kwanza, unasema sasa we understand, unatupatia answer hata 0. So in the process una understand. Lazima ukue mwanafunzi who is very very jovial, somebody who is asking questions. You are ile mugaga na upwa, hali wali mkavu. Unaenda kwa samaki kugagana, unajikaza, wanasema unajituma, utapenda hii subject sana. Lakini ukiwa na mwanafunzi ambaye unangojea katika video kamoja kale kalifanywa last, ndio watch peke yake, itakupatia shida sana. So you must work together. We are here to help you. We shall be able to introduce very many sessions. Like, for example, if the students have also seen who are doing very well in this paper, you know, I keep on repeating these things. Like now there are these sessions that I normally introduce for the very new students who have just joined us. That's Monday. Although inakuwa ni a bit, ndio hii class yenu pia mko na kelele sana, sijui kwa nini. Mmekuja na moto mingi sana. FM itazima. So tuko na class ya Monday, Friday. So Monday and Friday huwa nakuwa na class ya newcomers ya 6 p.m. Newcomers. Even the old people still na join from wherever you are. It's a free of charge class for you. Right? So hata kana repeat the same questions. Hautaipata mwalimu na repeat questions kama mimi. Na repeat questions pako unakuwa an expert kwa hizi. So are there guys who can be getting time at 6 p.m.? Of course, I'm not teaching like something new. No. Those students who have attended, like now the questions that I was doing last time, Zamajas, I repeat the same questions. But now, of course, given that you are coming in now with a third eye, because you have seen this thing somewhere, you'll be able to understand much better. So in a class here, the students, students who would want to get like more insights. Like now these questions I've done today are the questions I'll be doing tomorrow, 6 p.m. Same question. You simply log in and attend. Trust you me, utapata concept. So it is either we attend these lives at 6 p.m. ama uende kwa LMS, watch. Uwezi ukaanguka. Ya kama Linda umeanza vizuri sana. Linda ameanza kuwa kimbelembele. Unaona kama amesema Marcelena. Linda ameanza kuwa kimbelembele, which is very good. I hope your Kiswahili sio mzuri sana, lakini yaani ule mwanafunzi mwenye anaongea hata kama nini figures amepeana, unaweka mkono juu unasema mwalimu, let these guys hear my sweet voice. You can never go wrong. So most important, don't like you to come and tell me that you are floating after 1 hour has lapsed. I know there is a problem somewhere. Why? Even today I'm a student. I can't sit down here like 30 minutes ati sielewi. Jamaa anaandika tu na t-shirt ka white. You need too much. Even 20 minutes. I'll just put up my hand and say, I'm wasting time here. I've paid for this class. I deserve to be taught. The future is luminous. That is the thing. And then the other thing, I've not seen you guys like your group ya kina Masileda. Sijasikia nyinyi mkisema mnaanza discussion yenu lini, discussion group. I mean, I would want to give you Zoom link. Ndio pia nyinyi mwanze kufanya discussions, even if it's once a week. You get a team leader. And team leader is rotational. All right? You get to discuss. It will be very, very good. So like now these discussions, when do you want to start them? When do you want to start? Because you must start them. So that I give you questions, with your discussions, I'll give you questions that are tough, and then I get to see how you are handling them. I would want to see how you are handling them. Because you see, AFM is about question twisting. It's about getting sadists of examiners You will think that you know, and then they twist questions somehow. So if we can start these discussions mapema, the better. Oh, the group discussion is active. Uongo Mahabub is not active. Yeah, like now we have finished this corporate restructuring. Like now corporate restructuring we have done. So we have done corporate restructuring. Go to the LMS. Corporate restructuring, go to the LMS. We have in this case here now I can count these mergers and acquisitions apart from now this valuation. Then now we have real estate. This time around we want to finish this syllabus very early with your help, of course, and LMS. Real estate. Real estate. And then we will really be able to move pretty fast. After I finish real estate, I'll go straight away to international finance. International finance is one of those killer areas we should be able to handle mapema kabisa. Mapema kabisa. So what have we agreed about? Number one, there is one that is active. Oh, there is a group. How comes you have never invited me? I like attending. So is it 4 to 6 a.m.? Oh, Monday niko na class ya AFR. Monday niko na class. But now tomorrow at exactly 4, I'll be in that group. Which link do you normally use? Which link do you normally use? One video. Nitaingia kwa LMS nione nini mnasema. Maybe you could be having some truth there. Nitaingia kwa LMS. Nitaingia LMS for some time. Mabu nikimaliza. Yeah, you need to add me. Na ikiwezekana those groups are supposed to be run by the college. Those groups are supposed to be run by the college. We need to protect our business because pale wanafunzi wakiingia discussion group wanapata mambo mzuri kutoka wanafunzi wangu na walipi fees. So kama your group, there is an official group ya discussion ya college. Nataka mtumie NJ. Nitawapatia link yake wala ambao mko. Nitawapatia link yake. Of course we took an initiative, but now moving forward ningetaka muweze kupata link ya shule. Link ya shule ambao inakuwa controlled na shule. Kisa nyinyi ndio ma-admin because nyinyi ndio mna-run. Nyinyi ndio mna-run. Na msiwache Kena kuwe na Baraka peke yake. Because nimeona mnataka Kena kuwe mwalimu throughout. No. Normally what we do katika discussions, the team leadership is rotational. Kena akifanya ya leo, ya Thursday inapewa msichana. Alafu anarusha ball. Anarushia mwingine ball. Everybody must have a turn on this table ya teaching. Everybody must have a turn there. How to join? I'll be able to give you that link. I'll be able to give you that link. And normally we have 2 groups. We normally have 2 discussion groups. Kuna discussion group ya early morning na kuna wale maninja hata ufanye namna gani hawezi wakaamuka 4 hata wa 4 saje inakuwa internet ama akiamuka the whole day atakuwa na mashida mengi. We prefer them having their own group during weekends. Unaona ndio sasa sio kupenda kwa kila mtu ameumbwa kivingine unaona. Mungu amepatia. So we normally having a group for them over the weekends. I can't wake up at 4 unaona. Si kupenda kwake. Sio kupenda kwake. Hata kiamuka anaweza kukosa kuwa productive kazini. So we also prefer having a group for those guys over the weekends. And those groups I must attend. Sasa ingine nikapata mwanafunzi anadanganya wengine sana. Nikiwa nadanganya wengine sana kwa wewe usikai kuja kufunza kwanza fuata. Nitawapatia link. Nitawapatia link ya discussion. Alafu discussion pia tunaenda topic wise. We don't just discuss anyhowly. To discuss topics ambazo zinafanywa na mwalimu. To discuss current topics, na ile topic ambayo mwalimu ametuambia tuangalie mbele. So mwalimu ana lead wanafunzi kama ni mambo ya real estate. You must watch real estate videos first. Ndio sikuje ku waste time sana kwa class. And then as we discuss theories za past paper for those topics unaweza kuzifanya mapema. Spin, sell off. Unaweza kuzidiscuss mapema sana with ChatGPT and whatever. You guys have got lots of resources really. Lots of resources. And of course the revision kits, lots of them. So discussion group na watumia saa hizi. I will suffer the whole day if I wake up at 4. Yeah. Wambuka revision kit, nunua hii ya nini? Nunua hii ya physical tukutumie. nunua ya physical tukutumie. Otherwise, asanteni sana, and I'm really sorry for the students wenye wameumia for 1.5 hours hajakuwa akifuata. I'm really, really sorry. Maybe hamkujua. Maybe the way I talk, mnaona kama this guy is harsh. No, I'm down to earth. I normally believe in being happy in serving. I serve happily. I want to serve humanity. That's why I'm introducing like this additional class kama ya 6 p.m. kesho. Na natuma link kwa hiyo 6 p.m. Friday free like that, so that we end up doing like 6, tukifanya 6-7 lessons a week uanguke. Kusema kweli pia tutasema huyu mwanafunzi hakuwa meant to be an accountant. Yeah. Alafu nakupatia advice which other course you can do. If we do, those are 2 sessions, and then now tutakuwa na 3 sessions ile normal. Those are like 5 sessions a week. Uko na LMS, uko na discussion group, uanguke. Hiyo tutaita priest kutoka Catholic Church akuwekelea mkono. Tuone kama uta change course ama utafanya nini. Because sasa itakuwa ni impossible. But what I know, the saviors hapo, savior kwanza ni moja, hiyo discussion group ya wanafunzi. Because now once I give you questions, like now this question ambao nimepatia, sasa naweza kuongezea homework. Because of the discussion group, naweza add question moja hapa. Now you guys are having a discussion group ya 4. So I can add 1 question. Yes. Well, that's an easy one. That's very similar. Yeah, December 2021, question number 2B. Now you'll have 2 questions. So these are the questions you should be able to discuss, Ken, tomorrow. December 2021, question number 2B. Now you have 2 questions za homework. Paul, lazima create time. Trust you me. Lazima create time. If there is a ninja who is busy, look at how I operate. You'll be surprised. If you get to see how my day is, Paul, I'm so sure always kuwa half busy the way I am busy. Half. And I've seen a student, I have 2 jobs, niko na main job, na niko na hustle yangu ya RCM. All right? I'm a family man. I'm so sure Paul, wewe kijana mdogo hatujaoa. Umeoa kweli? Paul, umeoa kweli? I doubt. Hakuna. It's about how you set your mind. Sylvia, hapa sasa angalia Sylvia. Hii si wanafunzi, hii ni question zenu, lakini kuna wanafunzi ambao wanakuja early morning kudiscuss. Wale wengine hawawezi kuja early morning, tutakuwa na klasi yao moja pia tutaweka weekend. Nyinyi ndio mtaniambia discussion group. Wengine wananiambia mwalimu, hii ya weekend sisi tuko na time ya Saturday 11 to this, Sunday to this, because every student must belong to a discussion group. Oh, 4 kids, then salutations hapo umenishinda. 4 kids, salute. Sasawa. Great. So then I'm also going to the to the LMS right now, and I'll be able to make a comment in an hour's time. Nione shida iko wapi. Shida iko kwa last semester videos ama this semester videos. Shida iko kwa last semester videos ama this semester videos. Or this semester ndiko na shida. Okay, that's very easy because we have them, and they are normally dated kwa Zoom. So nikuchukua dates na kuensure this semester. Okay then. Okay, sawa. All right. So thank you very much. Hapana topic wise. Hatuwezi enda topic wise. Unajua sasa tumekuwa waerevu umu. Unajua kuna topic utaenda uanze kufanya kama topic mnafanya na mwalimu. Uanze kushinda hapo capital budgeting the whole 2 months. Sasa hivi mtakuwa na shida. Sasa tushakuwa waerevu. Sasa hivi what we do, kuna those topics that are very important and they are very short. We tackle them those ones. Right? Labda kuja kwenda kwa mambo ya real estate. Ule mwingine kwa mambo ya KPM, narudi KPM baadaye. After kumaliza international finance. Sasa tushakuwa azifuati at topic no. No. Kama zangu sana nilianza na corporate restructuring, so nimeenda kwa mergers, all right? Nitaenda kwa real estate, so hivyo ndio utazipata zimepangwa hivyo. The most important thing is that they should be logical, arranged logically. Or we name, yes, sawa. The second question is December 2021, question number 2B. December 2021, question number 2B. Lakini wacha to agree pia on one thing. The students will not be doing homework. What should we do to them? There must be a punishment, a way of punishment. The students will not be like a whole month. We just review. Tuangalie huyo hajafanya homework hata moja a whole month. We should be able to introduce a punishment. Yeah. Tuwatume mzazi nyumbani. Yeah. Because kama sawa wanafunzi wa last semester, I can tell you this question. Hata kama mnalia ilikuwa namna gani, wacha tuziangalie maswali utaona. If you are very, very serious, you consider, I don't know. Point you left. Okay. When forward the video so as to start from the point you left before. Buy them lunch. Great. Mkate, luncheon at 5-star hotel. Wafieke kwa jirani. Yes. So, kasi nebisi wanyoroshe. Hii semester, by the way, kama kuna semester nataka tujitolee zaidi. Hata mniambie zile classes za lunch hour mapema. Yeye pia mwingine ananiambia mwalimu, mimi siwezi pata time hapa. Lakini naweza nikapata time lunch hour 1 p.m. Do we have students who can who may want 1 p.m. instead of 6 p.m.? Do we have students in this case who may want us to be doing some classes here instead of here? Because I like in this case here giving people, 1 p.m. is better. Oh, okay. Then deal tomorrow 1 p.m. Whatever will be, of course, in a 1 hour challenge kidogo ya 1 hour in 2 hours. Lakini saa tomorrow 1 p.m. Especially for the students in this case here who floated today so much. Those students that we are really, really very sorry. So tomorrow 1 p.m. Lastly, as I disappear, you guys are also floating because of what you're like now today. For about the first 30 minutes, we only had 60 students. Kutoka hapo wanafunzi wakaingia wengi 150. Hiyo 30 minutes ya kwanza mlikuwa wapi? Na leo ni Sunday, uzi niambia kwa jam. Okay, we had AMA. Kwanza okay. Tama. So then you see like now Mercy, that's why we need okay. Hiyo ilikuwa ni marketing. We had AMA. That's why we need a class rep. Class rep anasema AMA inafaa kuisha 8. Mwalimu instead of 8 be starting your class at 8:10. We give you 10 minutes. Class rep anafaa kukua class rep. Otherwise, asanteni sana, be blessed. But ultimately, the major objective here is that we should be able to pass. Ufalme wa mbinguni ni watoto wadogo. Lazima tunyenyekee hapa. Tukisema class kama asubuhi ni 4 ile ya discussion, don't come at 4:30. You must wake up on time. Thank you so much. Link ya 4, hiyo nitatuma. We shall overcome. Link ya okay, unasema ile ya 4 am. Nitatuma. No wonder. Utakamata, Kisaka utakamata, don't worry. Utakamata. Thank you so much. Wacha niwatumie link. All right. We shall overcome. Miki tunajua at the end of the day itakuwa sawa. Hii semester hakuna mchezo. Thank you, bye.